Ladies and gentlemen, welcome back to our Advanced Financial Management course, which we started learning. We started by outlining the topics, which we identified major areas, which are 9 of them. I hope you are able to see my screen. One of the topics, that is topic number 1, is advanced capital budgeting. We listed them from number 1 to number 9, including risk analysis in capital budgeting, portfolio theory and CAPM, international markets, derivatives, mergers and acquisitions, corporate restructuring, replacement analysis, and finally, we identified financing decision as the last area to look at under the coverage of advanced financial management. We now started by topic number 1, which is advanced capital budgeting. And ladies and gentlemen, we looked at the simplest definition possible. And the definition we gave, we said that capital budgeting is a step or an activity which involves committing funds in long-term projects and the returns that come out of it. Sometimes you call it the yield. They are realized in the future. So from that definition alone, we were able to go ahead and now identify what are the special features that define a capital budgeting project. And from the definition, we were able to point out 2 of those elements or features that stand out. One of them being these projects are long-term projects. So that is one of the features of capital budgeting projects. Then we went ahead and also identified another one from the same definition, and we said benefits or the returns are realized in the future. They are not instant, they are not current. Because these are long-term projects, now the returns also are realized in the future. We went ahead and gave the third element or the characteristic, or you can call it a feature, of these capital budgeting projects. And what did we say? We said these projects are also highly risky. So being risky is another feature of a capital budgeting project that formed our third element or characteristic or feature. We went to the fourth one and we said it involves huge capital outlay. So ladies and gentlemen, these capital budgeting projects involve huge capital investment at the start. So that formed our third element, our fourth element, sorry. Then the fifth element or characteristic of this capital budgeting project was once you invest, it might not be very easy to reverse because it involves huge capital outlay. Once they are consumed, the resources have already started being in use, they've already been absorbed, you are not able to reverse. So those are the 5 features or characteristics which we identified for this capital budgeting projects. Again, we went and now narrowed down and asked ourselves, we've already looked at what capital budgeting means in definition. We've already identified the special features or characteristics of these projects. Now, let us go ahead and look at the types of capital budgeting projects. What are these types? We gave around 5 of them. And the first one, which we gave as a type of capital budgeting project, is we said we have mutually exclusive projects. Another term for the same was complementary projects. So before you even overthink about what it means, I want to look at the complementary part or mutually exclusive. And we gave the simplest description to enable you understand it. Let it stick and just say, because they're complementary, they complement the other. Yeah, they are mutually exclusive. Now, these projects serve the same purpose. That's why we call them complementary. And what that simply means, if you decide to undertake one of the projects, you will automatically disqualify the other. And I gave you a very simple example, an example that you can relate with. And we said, for example, in a school, if you want to buy a school bus and you have 2 options or the 2 projects there, you will either buy an Isuzu bus or you will buy a Nissan bus. I'm not promoting any of these brands, but I'm using them as examples because we can relate. So once you decide to buy a school bus, remember, you only need a school bus, but you have 2 different brands. So if you go for the Isuzu bus, remember, you will automatically abandon the Nissan one because you only needed 1 school bus. That's what your resources can allow. Those type of investment or project, we call it mutually exclusive. You choose one, you exclude the other, or we call them complementary. They serve the same purpose. You have to make a choice. That was the first type of capital budgeting projects. What was the second one which we looked at? Independent projects. Ladies and gentlemen, from the term itself, you are able to relate. Because they are independent, they are projects that do not depend on each other. Once you decide to invest in one of them, that investment does not interfere with the other one. Depending on the availability of resources, you can always invest in both of them. So we gave a simple description and we said these are projects serving different purposes. So because they serve different purposes, any investment in any of them or both of them will depend on the availability of resources and the decision to do so anyway. So we said they do not interfere with each other. Independent, they are independent. Then we went to the third type of capital budgeting project, which was dependent project. So it is the opposite of the second one. So what are these projects that depend on each other? Remember, when we talk about independent, they don't depend on each other. But now on dependent ones, they depend on each other. They complement. Another term for dependent projects are complementary projects. Now, I give you another example relating to that definition so that you'll be able to understand. And we said, these projects, once you invest in one of them, that investment will require or will call for the need to also invest in the other. And I gave you an example of the same one which we used in the first one. When you talk about mutually exclusive in the first type of capital budgeting project, we said mutually exclusive projects, right? You remember that? That was number one. And we said in mutually exclusive projects, once you invest in one, you automatically abandon the other. Now, when we come to dependent, I want to use the same example of bus, of school bus. When you invest in a school bus, remember the project was a school bus. Once you bring this bus to the school, after you've identified which one to go for, remember, this bus must have a driver. Driver was not the project was the bus. So once you invest in one project, which is in this case is the bus, you have to also engage the driver. That is another investment that comes because of this first one, to complement the first project. So that's why we call them complementary, dependent projects. One project depends on the other. The bus cannot drive itself. You have to engage a driver to drive that bus. Those are dependent projects. That is the third type of capital budgeting projects. What of the fourth one, ladies and gentlemen? We call them divisible projects. And I give you a very simple way to also master it. When you talk about something which is divisible, the example which I gave you, which is very notorious and you can easily relate, is when you invest in a rental house. Remember, divisible projects are projects that will start giving you returns or will start generating for you cash flow even before you complete them. Remember, when you invest in a rental house, even before you complete the construction, those completed units can always be occupied and the tenants will be able to pay you income even before you complete the whole project. Is that true? I believe so. So that project falls under the category of divisible project. Now, another example which you can also relate with is professional services. Remember, I want to give an example of the course we are studying. And if you are studying CPA, Certified Public Accountants, before you even finish the certified public accountants, whatever level you've reached can be able to land you a job. You can even get a job with CPA, let's say intermediate level or section 2 or section 3. Now, you've not finished the project, but already it is giving you returns. Those projects are called divisible projects. Now, what is the opposite of that type of project? That gives us number 5, which is indivisible. Now, when they cannot be divided, they cannot be able to give you returns before you complete them. That is the opposite of the one in number 4, which we've just discussed. So these are projects that do not generate inflow before they complete. So I think that is very, very clear to understand. Now, ladies and gentlemen, we move to the next stage. And remember, once you've identified the type of capital budgeting projects, you've seen the definition, we've seen the features or the characteristics. Now, someone will ask, now, after all these projects, you've already seen even, those projects that mutually exclusive projects, you've already seen the complementary projects that complement each other and all that. Now, let us sit back and ask ourselves, how do you tell which project is viable. How do you evaluate? How do you appraise a project so that you'll be able to say project A is better than project B? Now, this brings us to project evaluation techniques. And project evaluation techniques are divided into two major categories. First category is non-discounting techniques. Those are techniques that do not involve any discounting. Then discounting techniques, we discussed it, and discounting techniques now, you will have to discount the expected cash flows. Remember, you are appraising a project from the start. You want to make what we call a decision. And whenever you are making a decision, you are making a decision before you invest. Is that true, ladies and gentlemen? I believe that is true. So as you make that decision, you are working with projected future cash flows, expected cash flows. So you can either discount these cash flows so that you make a decision today, or you can just work with them the way they are without discounting. Remember that. So these are the two broad categories, and let us start with the non-discounting techniques. Now, from the simple description, the simple, how the term is non-discounting. And when I talk about discounting as a finance management student, I want you to remember we have two alternatives. You have a discounting and compounding. Remember, when you talk about cash flows, there is the value today, which is the present value, and there is the value in the future, and we call it future value. So, in that perspective, you remember we have our two major elements: present value interest factor. That is the discounting factor. Whenever you want to look for the value today, present value interest factor, and that comes under discounting. That's what we said. Then, what of compounding? Compounding helps you to get future value. Now, I want us to look at non-discounting because we don't use discounting factors under non-discounting. And discounting techniques are majorly two of them, as we had mentioned. And one of the major differences between discounting techniques and non-discounting techniques is time. Now, in non-discounting techniques, you do not take into account time value of money. But in discounting techniques, you have to take care of time. The time that the investment is taking affects its value. And I believe as a finance student, you are aware that value of money today is different from value of money tomorrow or in the future. Now, the two major non-discounting techniques that we had narrowed down to are payback period and accounting rate of return. Very, very interesting. And the discounting techniques that we had identified, we said, now these are the techniques that will take account or make account of time, the time that the investment takes and the time that you are realizing the cash flows will affect its value. Time value of money is taken care of here or is accounted for. And some of these techniques, one of them is discounted payback period. Remember, payback period is an undiscounted technique. But when now you discount the cash flows, now you are talking about discounted payback period. And because it takes care of time or time value of money. The second one, the second discounting technique is modified internal rate of return. And modified internal rate of return, we are going to look at it. What do we call, what do we mean when we say internal rate of return? We are going to discuss it in details, ladies and gentlemen. So do not worry. Do not worry. Just hold it there and you will understand. The third type of discounting technique or project appraisal technique is profitability index. Profitability index is also another technique under discounting techniques. We are going also to dive deeper to look at it in very, very fine details. Then the third one, which we had not listed, and we need to also look at it after profitability index, is something we call net present value. And that forms number what? That forms the D. Our numbering was using ABCD. So that is D. D. We call it net present value. Net present value is a very, very interesting evaluation technique. We are going to look at it, and I believe you're going to understand how interesting it is. Then we come to the fifth one. We call it internal rate of return. We normally abbreviate it using IRR, Now, without skipping a breath, I would want us to now dive deeper and look at it in a perspective where, out of all these project appraisal or project evaluation techniques that we've listed, from both the two categories, non-discounting ones and the discounting techniques. Now, what features, what are you looking at? What are your areas of consideration for you to say that I will prefer to go with the discounted payback period, or I would want to go with profitability index as the best method to use in this evaluation exercise I want to do? You want to appraise your project. What informs your decision on the type of technique to use? That's what I want us to narrow down and look at. What informs that decision? Now, whatever informs that decision depend on various features. Now that brings us to a discussion where we are talking about what are the features of the best investment appraisal method to choose. Or sometimes you can reframe and call it characteristics of an ideal investment appraisal method, or the best investment appraisal method that you want to decide and use. So let me write that headline here so that we move together. We move together. We say characteristics of an ideal investment. When you talk about ideal, this is just the best choice. Ideal investment appraisal method. So what are the features of the best investment appraisal method that you want to choose? You want to do appraisal of a project. Now, what informs that decision to pick the best? Number one, the whatever method you want to choose to pick or to use to evaluate a project, remember, it needs to take into account time value of money. So that takes us back to the major categories of you remember this, the major categories of the techniques. We have non-discounting and discounting. So when you talk about the best method to use to evaluate, remember, time value of money is important. So that already brings a hitch on non-discounting techniques because they do not take into account time value of money. So discounting techniques are more preferred in that case. That is one of the features that you have to consider when you want to choose which method to go for. And that gives us the first feature or the first characteristic, and we say that technique that you choose, it should take into account. It should take into account time value of money, time value of money. That is the first guidance or the first characteristic of the best investment appraisal method, or the most ideal one that you should use. Now, another area or another characteristic of the best investment appraisal method that you should choose to do your appraisal or your evaluation, make sure that it uses cash flows rather than accounting profits. Remember, when you invest in a project, your interest is the returns, and the returns are being, they are being computed using the cash flows. The flow of money, remember, as an investor, your interest is what you get in return. It is not about what is computed under this, the published accounts, the statements. When someone publishes a statement, for example, income statement, that income statement will just show you an accounting profit. And whenever you see the accounting profits, that does not automatically translate to cash flows. It might show that you are making profits as a company, your income statement, but then when you start tracing the flow of money, you realize that it is not giving you the correct picture of the cash flows. That's why whenever you want to choose the best investment appraisal method, remember that method should be able to use cash flows instead of the accounting profits, because accounting profits can can make you make a wrong judgment or will not give you the correct perspective of the cash. Remember, as an investor, cash is king. Now, we say it should use cash flows rather than accounting profits. It should use cash flows rather than accounting profits. And I believe this is something which is self-explanatory. Then now we come to the third one, What feature or what characteristic will underline or underscore the best investment appraisal method? And we say this method that you want to choose to use to do the appraisal, it should give you clear indication on whether you either accept or you want to reject that project. It should give you a measure. It should give you a reference point so that you don't just work out blindly. Once it guides you on the method you want to use to appraise, at the end of it, it should give you a point where you want to make a decision. Now, what are the limits of making a decision? What guidance does it give? That forms a basis of one of the best appraisal methods that you need to choose. So it at least guides you. So we give the third characteristic and we say should give a clear indication. Should give a clear indication. Should give a clear indication on whether, sorry, I did not write it well, on whether to accept, or reject a project. So that is something that, that is a feature. That is one of the areas you need to look at if you want to select on the best appraisal method to use. Then again, remember, when we talk about the cash flows, we said in the second characteristic, we said this method should be able to use cash flows and not the accounting profits, which are normally shown in the statements, because accounting profits will always misguide you, can give you a wrong picture because it does not translate to the cash flows. Now, the fourth characteristic or feature that I want to bring on board as you choose which method to use, remember, the cash flows, you should use all the cash flows for all the periods so that you get to see the best, the most clear picture. For example, if you have a project running for the next 10 years, you expect it to run for 10 years, but then this method that you want to use do not take care of all the cash flows for the next 10 years, the projected cash flows. That method might not give you the best picture, or it might not really help you to evaluate these projects very well, because remember, cash flows vary from one period to the other. It is not constant. So because of that, it is only fair, and to have the best picture, the clear picture possible, you need to be able to take into consideration all those cash flows for all that period. So that gives us the fourth feature or characteristic to consider when you want to choose the best method or technique to use in your project evaluation, which now we say should consider all cash flows for all the periods. It should consider all the cash flows. It should consider all the cash flows for all the periods, for all the periods. So if it is a project that is expected to run for the next 10 years, please look at the projected cash flows for the whole 10 years. Then, is there another characteristics I'm leaving out? I'm looking at, with the first one, we talked about time value of money. The cash flows number 2. Then we've also talked about to give you a measure whether to accept or reject. Then we said that this method should be able to consider all the cash flows. Very good. Now, assuming I'm looking at another feature, assuming you have, for example, four projects, and the first 4 features have been taken care of. Now, this investment method that you want to choose, the method to choose to select one out of the 4. Remember, you've just considered that cash flows are considered, all of them. You've looked at, it should help you to identify whether to accept or reject that project. Then we've looked at the cash flows, and time value of money is taken care of. Another thing that we should not forget, remember, you need to be able to rank the projects. It is not always one project which is best in most cases. You should be able to rank them and be able to identify which one takes precedence, which one is the best out of the best. Then you go to the second, third, like that, so that you choose the best out of the best options that you have. Now, that gives us another feature, and we say it should help in ranking independent projects. It should help. It should help in ranking independent projects. Remember, I hope you remember what we mean by independent projects. These are projects that do not depend on each other. Investment in one do not affect investment in the other. The only factor that you consider is availability of resources. And now in this case, we talk about the viability. How viable is the project? Sometimes you do not invest because you have the finances or the capital to invest. You have to look at, is it a viable investment or not? Very good. So ladies and gentlemen, I want to believe that we've looked at these characteristics up to that point and we are all together. Now, let us now move a notch higher. We move to the next stage. Now that we've seen and also agreed that whenever you want to choose a method to appraise a project, this method should take care of time value of money. That now narrows down our view from the two broad categories of project evaluation techniques. Remember, our broad categories were non-discounting and discounting, and the difference was about time value of money. So because it is a major area to consider when you want to choose the best method to use for evaluation, now we go and start looking at discounting techniques, because now that is the most interesting area. It takes care of time value of money. So let us go and look at the discounting techniques. Discounting techniques that take care of time value of money, time value of money. So I will go ahead and say discounting techniques, discounting techniques like that. Discounting techniques. And remember, we had listed them. And the first discounting technique, which we talked about, if I can go back to what we discussed, we said discounting techniques are a discounted payback period, modified internal rate of return, profitability index. I don't want to repeat writing them. Net present value and IRR, internal rate of return. So as we start going to this, discussing discounting techniques, we've already named them. So the next step is, how do we use these techniques in computations? When you talk about, for example, the first one, I want to call it A. We said this is discounted payback period, discounted payback period. Now, this is where discounted payback period, let me use those initials to represent it now. This discounted payback period, the best way to help us or enable us understand it is to look for a question. And now I want to take us back to a past paper question, which was done in May 2014. May 2014, let me look at that paper. So I will pull down this screen and project another one, because now we are going to computations. And I want us to now be very, very careful, because this is now where we are testing our understanding and how to apply these techniques, And I believe we are together, because this is the essence of the learning itself. Very good. So let me look for that paper and we start straight away from the illustration using the past paper question.